Greetings, members one and all of the Salivation Nation. Gold in the age of inflation. We're going to look at inflation and gold in different perspectives in the extreme and maybe find some common ground in the middle. Let's explore. Yes, there's extreme views on inflation and gold, whether it be mentioned or not, in two different infographics here that we're going to be discussing. You know, it's kind of cringeworthy to think about me being in the middle on some things. I do like to be balanced in my viewpoints, but I do consider myself an ideologue. I believe in fundamental principles of liberty, individual responsibility, and in terms of our monetary system, I'm very much in the supply side and camp in terms of the economic theory, Austrian school, I guess you would call my viewpoints. But nonetheless, there is some nuance. And I think nuance and discussion and kind of understanding that a lot of different factors can come into play are things that we should consider, no matter how stringent our thoughts are. The answer to everything is not just gold and silver, in other words. And by the way, there are other reasons why inflation is so high. And we're going to look at it from one extreme, and then we're going to look at the other extreme, but we're going to pick apart both to a degree here. Why is inflation so high? According to this infographic here, which comes from more the demand side and more on the left leaning for economic theory, I guess you would say. And this is an infographic from last year when we started to see inflation go up. And just what can happen in a year, this has been going on for over a year. Now the consumer price index rose 6.8% in 2021, understanding that the target is about 2% from the Federal Reserve. At a glance, it's an increase in the price of goods or services due to weakening currency caused by surge in product demand, production cost increases, supply chain breakdowns, and changing house prices. Now, that's what they say is caused by, but we're missing what it's really caused by. In other words, these things are factors that come into play, but there's missing something here. I think most of us understand what it is, and I'll talk about what that is momentarily. There's two major theories, they say. Cost push inflation, higher costs raise prices. And then demand pull inflation, demand outpaces available products. And that's true, but you also have to think about the supply side that is happening from one end and to the other that is helping to cause some of these issues. Inflation is measured by the Consumer Price Index. And by the way that they measure that has been changed twice since the late 70s and early 80s. What does a Consumer Price Index measure? A basket of goods like housing, food and beverage, medicine, recreation, clothing, education, transportation, and miscellaneous. The Federal Reserve aims to keep inflation at 2% or less. In fact, before we saw this inflation start to go up, they were okay with about 2.5% inflation. We knew then that there was something that was afoot and was about to happen here. In 2019, before the pandemic, it was 2.3%. So a little bit outside of what they had wanted. And keep in mind that even in 2019, we were spending a lot of money before the pandemic. Now, in the pandemic in 2020, it went down to 1.4%, and there's a reason for that. The lockdowns, the shutdowns, the economy was put on pause. We're still recovering from that, by the way. In 2021, after all the massive spending that started in 2020, look where it is, 6.8%. Inflation rates are higher than ever, with the biggest jump in more than 30 years. So let's look back at a history of inflation according to this. And again, you'll understand what is missing from here so far, blaringly missing. Two things. We'll get to that in a moment. Inflation rates are higher than ever, biggest jump in more than 30 years. In 1778, we had the highest inflation rate of all time, 29.78% according to cultural data. This is before there was any scientific measurements or standards from which to compare. Now realize that during that time you had the continental currency, and there was a lot of that was printed in order to fund the Revolutionary War. And it was really, the nation was young. There was no U.S. mint at the time, and there was no greenbacks. It was continental currency, and it was printed in all of the different colonies at the time. For all intents and purposes, though we declared independence, we're not fully independent, and it was a time of struggling for that independence. 1783 with the Treaty of Paris, and really the United States, under the Articles of Confederation, was very loose as a nation, and really we did not become that nation until the Constitution was ratified by the states starting in 1787. Then in 1913, a big jump. Notice that there wasn't a whole lot of data here, like the Panic of 1857 was one thing, and what started the Panic of 1857? It's what's missing in this infographic. We'll talk about that later. Panic of 1857 is very important, and it's not talked about in this for good reason. The only time it's mentioned is in the next thing, 1913. The Federal Reserve signed into law. In 1913, money was backed by the gold standard. They conflate the two. There is no conflation. In fact, in 1913, in December of that year, with the Federal Reserve Act signed into law, was the beginning of the end of the gold standard. In 1919, CPI compiled for the first time, collected as weighted average prices. So that happened. There was also a panic that year in an economic downturn, which in the early administration of Calvin Coolidge, he brought us out of it by using supply side and theories, and essentially laissez-faire, the economy recovered. In 1965 to 1982, that was known as the Great Stagflation. Inflation rose more than 14% at its peak, and that was the way they used to measure the CPI during that time. Now it's measured very differently. In fact, we look at inflation now in 2022, it's really closer to 16% if we use the same measures that they did from 1965 to 1982. Then we had the Great Recession in 2008, which did not have inflation tied to it. In fact, most of this historical information has nothing really to do with inflation other than the highest inflation rate of all time then, and then stagflation. But the Great Recession, there was no inflation. It's caused by policies attempting to reduce inflation, is what they said here. But nonetheless, really, there was other things that were happening in the Great Recession that led to it, which is mainly predatory lending, and that's by easy monetary policies, quantitative easing and the like. And that was what was done afterwards, which exacerbated inflation. They didn't talk about a lot of that stuff that happened after 2008, which made it worse. QE1, 2, and 3, and now to infinity. 2021 prices are 15.53 times higher than the average prices of 1921. So that's 15.5 times higher in the last 100 years. Compared to last year, in other words, 2020, used cars have gone up 29.7%, food up 8.3%, healthcare 6%, clothing 5.6%, energy 4.6%. And that was from 21 to 20. It's even worse now, obviously. America had the 8th highest inflation rate in the world as of the third quarter of 2021. So this is how the U.S. controls runaway inflation now. And this is pretty accurate as to what they're doing right now. Does it mean it's the right thing to do? Well, no. They're missing something else there, too. Number one, reduce the amount of money in circulation. Decrease bond prices. 3, reduce interest rates through the central bank. But these sometimes have unintended consequences, such as reducing recessions, decreasing spending power, and create job loss. What's another way that can decrease inflation? Put it in the comment section before I tell you. And here, as we move ahead here, the United States has experienced more than 19 recessions in less than 100 years. 19 recessions. The Federal Reserve Act was to help control the economy to prevent these things from happening. Yet they still persist because the Fed is not the all-powerful machine that a lot of people give faith in, including today with what's happening with inflation. So what to expect from an ongoing inflation? Lower unemployment rate. Unemployment dropped to 4.2% in November of 2021. Higher wages. So these both sound good, but yeah, people got to work harder to earn more from decreasing value of their dollars. Higher wages, but they're not keeping up with inflation. Changing investment preferences. And so there it is. You got to change your strategies. Lower savings rate. Average rates range between 0.01 to 0.1 annual percentage rate, far below inflation. That's persisting today. Increased interest rates, and that is happening for sure. Rate hike of 3% by 2024, and we're talking about for the that they're going to continue to pump up. Now they're going to have 0.75% at least coming very soon. Higher cost of living, of course. Cost of living adjustments will be applied as well too. Herbert Stein, presidential economist, I don't know what his political or his economic philosophy is, but he says inflation came in various forms, sometimes led by wages, sometimes by prices, by foods, oil. Sometimes it was domestic, sometimes imported. Many programs have been launched to stop it without durable success. Inflation seemed a hydra-headed monster growing 2 new heads each time one was cut off. So, protecting yourself from effects of inflation, this is what they say: invest in stocks, not financial advice. Purchase some property. Good rentals provide a minimum. Increase your earnings potential through education. 30 million Americans could be earning 70% more. Consider commodities, foods, and industrial metals. Interesting. Raise retirement contributions. So be ready to protect yourself, to protect your finances. So what's missing from this infographic? Number one is the biggest driver of inflation, in my view, is increased money supply. Printing money, diluting the money supply by printing it or digitizing it is massive. It's not to say that these other factors don't come into play and cause some effect, but they are a result of money printing. And that's happened time and time again. And what is also missing here that was only mentioned once is gold as a way to protect yourself against inflation. Now, even though some will say, well, gold's gone down since inflation really started picking up. And yes, it does at first. Why? Because people run to the strongest thing, and that is a hope that the dollar will be strong. So the strength rise, the perception of strength is by the dollar index, and bond yields rising as well too. So that's where people run when there's economic uncertainty, and inflation is economic uncertainty, that's for sure. That's where they go. Another solution that they don't talk about here that I mentioned before is to stop the spending. Government spending has got to be stopped or slowed down dramatically. Streamline government, because but they want to do the other way. They want to stimulate coming from the government, and to me that is not the answer, and it isn't the answer. Now let's take a look at the other side and pick this apart. In an era of inflation, gold reigns supreme. This is from U.S. Gold Bureau, which is a dealer. So take everything they say for a grain of salt as well. Gold reigns supreme. So here, and this is a more recent infographic here, 6 cents in 1922 has the same buying power as $1 in 2022. That's dramatic. 100 years, and look at that difference. Inflation is taking a toll on the dollar. In 2022, inflation rose 9.1% at its peak, the fastest pace since 1981. Consumer prices are on the rise. 10.9% increase for food. Energy index 32.9. All other items are a 5.9% increase. And inflation isn't expected to slow down. By the way, these are the numbers ending in July 2022. In 2021, the U.S. dollar depreciated 16% compared to the Mexican peso and Australian dollar. That's as far as its value is concerned. That is different than the strength of the dollar, according to the dollar index, as a measure of a breadbasket of other currencies from the IMF. There's a very difference. 12% compared to the Canadian dollar, although that's a little hard to believe because I think the Canadian dollar is back, but who knows? And 9% compared to the euro, British pound, and Chinese yuan, although the pound and euro are suffering more now. Since 1933, the dollar has lost 99% of its value against gold, and that is staggering. So when we look at the future forecast, you can see all of these different factors here. Take that for a grain of salt, especially gold's price at $8,900. In 2030s, who knows? I really would just kind of ignore this panel, but we can see the rate that it's going. These numbers seem believable considering the rate where things are going. And gold obviously looks to be a promise to go up, or looks to have the potential to go up, but look at the curve, it's not quite as static as these other two. And even for milk, it's kind of off kilter a little bit here, but still, other than that anomaly, it's been on a steady increase. Runaway inflation rates suggest that $1 in 2030 will equal 65 cents in 2030. That's staggering indeed. We can see the history of where things have gone throughout this time period, and what has occurred here. When paper money systems begin to crack at the seams, and that's just it, that systems begin to crack when people lose faith in them, gold could explode, and that is true. That's from Harry Browne, who, by the way, I think was the first presidential candidate to run under the Libertarian ticket in 1996. So why is gold so valuable? Well, there's a lower risk. Gold is one of the few investments with a zero counterparty risk, which, by the way, means that it's not an investment at all. Probably that the other party will be default on their obligations. And it's tangible ownership. Precious metals cannot be reduced in value by mass printing. A set amount of 244,000 metric tons exist on Earth. You can't print gold. And gold has an increasing value. I saw a 101.1% surge in interest during the 2008-2012 recession. More investors poured their money into gold, increasing its value. It is a higher yield than traditional savings account. Gold has a 24% return on investment rate in 2020. Stock market investment return rate in 2020 just averaged 18.4%. But keep in mind, those numbers are a bit tweaked a bit because early on in March, gold dropped down dramatically during the run to the safety of the dollar. When that's kind of what's happening now, but to a lesser degree. And so when gold peaked in August of that year, that's that 24.6. That is atypical. That's taking the best case scenario in a given year. And then the last one is stronger demand during an economic strife. 1 in 6 Americans bought gold or precious metals in 2020. Now that is news to me. That is amazing that 1 in 6 Americans bought gold or precious metals. Does that include gold wedding bands? Because almost everybody buys gold then, and people did get married in 2020. So I don't know that I necessarily believe or like to see more data behind that statistics. And then we have the Mark Twain quote that history doesn't necessarily repeat, but it often rhymes. And it is good to protect yourself with gold, but keep in mind that right now, if we look between 2020, the high of where gold was at 2020 to where we are at now, gold has not been a safe haven compared to if you bought all the gold in August of 2020, and even on the way up or on the way down from there, gold has not really done all that well in the last couple of years. So keep that in mind. It's going to take time. It's going to take time, and it's going to depend on how you buy it. You use dollar cost averaging at the least, and smart dollar cost averaging at the most, and you're going to do just fine with gold as a protector against economic instability. So there you go. That's the difference between these two infographics. One mentions gold not at all, except for just a brief mention in passing, and this is a little bit too bullish on gold. But gold, in the age of inflation, will preserve your wealth in due course. Due course being the key words there. Let me know what your thoughts are in the comment section below. I'd like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.